Does the FIRE community and the Bogleheads community and online DIYers, do they have a selection bias issue? And when we talk about needles and haystacks as a metaphor for stock picking, well, what do the numbers of the stock market say about the frequency of those needles? And then last, make sure you stick around today for a light-spirited, fun debate about 10 retirement planning topics with Andrew Giancola.
Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 139. I'm Jesse Kramer. I'm a financial planner working with retirees and busy professionals thinking about retirement from all across the USA. You can learn more at planwithjesse.com. That's planwithjesse.com. Hey, a quick review of the week. Dave K100, thank you for the 5-star review on Apple Podcast. Please drop me an email to jesse@bestinterest.blog so I can get a super soft t-shirt sent out to you. And on with the show. First, I'm convinced the FIRE community, the Bogleheads community, the online DIYer communities have what's called a selection bias issue. So what is selection bias? Selection bias is a systematic error occurring when data points are not randomly selected, making the sample unrepresentative of a total population. This creates a distorted, unreliable conclusion because the analyzed group differs significantly from the population intended to be studied. What I know of my listeners here, what I know of you all, is that a lot of us are DIYers, a lot of us are Bogleheads, a lot of us are aware of or consider ourselves part of the FIRE financial independence movement. And I think we are a group of people who have self-selected to be DIYers, to be financial experts. We love getting in the weeds of our financial plans all the way down to the little details. And I certainly come from the same ranks as you. I've read those books. I've read those blogs. I listened to that podcast. My portfolio looks a lot like yours. And I think naturally, we are going to be very pro DIYers. A lot of us, understandably, might lean away from ever hiring a professional, at least when it comes to this financial planning world. And I think that's totally understandable. However, it's important to know that the more we interact with people like us, the more we can convince ourselves that everyone is this way. And I think some of that, it really is the online echo chamber effect. It's driven by confirmation bias, by the false consensus effect, and just by conformity. But we should be aware of selection bias and those other biases I just mentioned too, because it can distort our understanding of the world and, more importantly, how we communicate and help the rest of the population. So I felt some inspiration for this little monologue when I saw an online commentator say, and I quote, "The entire financial advice industry is a scam, bar none. Literally, every advisor, coach, planner, etc. is a scam. Just buy index funds and wait," end quote. And when I saw this comment, I thought of that Dunning-Kruger effect, the Dunning-Kruger curve, which shows competence on the x-axis and confidence on the y-axis. And what the Dunning-Kruger effect shows is that there's this really sharp peak early on when someone has a really, really high confidence, even though technically speaking, their competence isn't that high at all yet. And the kind of comment that calls the entire industry a scam, clearly, it's an imperfect industry, but not the entire industry is a scam. But that type of comment comes from someone who I think has high confidence, but low competence. And we've all been there at some point. Now, I think many of us, thankfully, have kind of matured from that point. But when I saw that comment, I thought to myself, I come here to help people make better financial decisions. I want to help fellow FIRE folks and Bogleheads and DIYers, and I want to help other people too. And what have I found interacting with hundreds and hundreds, if not even thousands of readers and listeners, like literal one-to-one interactions via email and talking to you on the phone and that kind of thing? What I found is that there's a huge part of our population, our friends, our family, our colleagues, our peers, who want nothing to do with Bogleheading, DIYing, being a diehard FIRE person or any variation thereof. They do want best practices in their life and in their retirement, absolutely, but they do not want to navigate the weeds like you and me. And I think when we encounter these people, there are two ways to possibly respond. The first way is to say, yeah, you're saying that, but you're actually wrong. You say you don't want to be a DIYer, but trust me, you do want to be a DIYer. Or the second way you can respond is, you know what, I get it. Some of us might enjoy DIYing our long-term finances, but yeah, that's not for everybody. If someone wanted to hire a health coach to help them get in shape, would you tell them, no, you don't need a health coach. Just keep on white knuckling it, because that's what I did. I think that advice assumes that our experience is the only path. It can ignore how tough the process can be for someone else. It comes off a little bit as, I struggled here and you should struggle too, rather than offering help that could make things easier or safer. And we need a reminder. Sometimes our biases hurt our cause. And so the conclusion here, I think, is simple. We all enjoy a shared path together, but not everybody is like us. And now I want to pivot to the really cool ideas about stock market investing. And I originally wrote an article in 2023 called The Needle in the Haystack. We'll link to that in the show notes. And it was based on some data that a professor, I think from the University of Arizona, Henrik Bessenbinder, some data that he put out in 22 or 2023, really interesting data. But in March of 2026, just recently, he put out even more data, new data, and it is even more interesting than what he did in 2022. And the results, the new results, similar to the old results, is very, very clear. And that result is, man, good luck if you want to pick individual stocks over the long run. Some highlights of the new study that I think are really cool. So he looked at, it was Professor Bessenbinder, that is, looked at 29,081 stocks. So over 29,000 stocks that were publicly traded at some point between 1926 and 2025, a full 100 years of data. And that full data set yields a compound average return of 10.1% per year, which is somewhat in line with what a lot of us have heard about stock investing for the long run. Yeah, it's about 10% per year. Now, of the 29,000 stocks, only 48%, so a little less than half, generated any sort of positive return, and only 41% of the stocks generated a positive return that was greater than 1-month treasury bills, the so-called risk-free rate. And then last, only 28% of the stocks actually outperformed the market, actually outperformed that 10.1% year average. So very, very few winners, so to speak. But then Bessenbinder goes a little bit deeper. He introduces a new term that he calls shareholder wealth creation. And more or less, shareholder wealth creation is just a way to measure performance. Bessenbinder does put a few small twists on kind of classic performance data, so it's not quite apples to apples, but by and large, shareholder wealth creation is simply a way of measuring how stocks create wealth for their investors. And the total shareholder wealth creation from 1926 to 2025 across the 29,000 companies over the last 100 years totaled to $91 trillion. But the specific data about that $91 trillion is really amazing because only 46 companies out of 29,000 total, only 46 companies account for 50% of the 91 trillion. That's 0.16% of the companies account for half of the wealth creation. And then 1,000 companies, 1,082 companies technically, account for 100% of the 91 trillion in wealth creation. And 1,082 companies out of the total, that's 3.7%. So the question might be, well, how could 3.7% of the companies create all the wealth in the stock market? And I think the way that to explain this, let's start by thinking about the very worst companies first. So Bessenbinder found that 17,197 companies, 17,000 companies, actually reduced shareholder value. They destroyed wealth in this study, and they did so by a total of $10.67 trillion. So starting with the worst 17,000 and change companies, we're in the red, we're below zero. And then the study found that it took the next best 10,800 decent companies to generate a positive $10.67 trillion, bringing the net value creation back to zero. So if you sum up those two groups, you have 27,999 companies generating a total of zero net wealth enhancement as they collectively matched treasury bill outcomes. 28,000 of the 29,000 total companies basically get you the same exact return as treasury bills, and that leaves the remaining 1,082 best companies in the study, which account for all of 100% of the 91 trillion of positive wealth creation. Now, the most charitable conclusion from the study is that, 59% of the haystack is rotten. Those are the companies destroying value. But at least 41% of the haystack is semi-decent, with this sliver of that 41% that is outright terrific. And that's the most charitable conclusion, is that more than half the haystack is rotten. But I actually think the more accurate, the more realistic conclusion is that 96% of the haystack is basically just a waste of time, getting you the same exact returns as treasury bills. Less than 4% of the haystack provides the true long-term return on investment that we are all looking for. The stock market has very, very few needles. 4% of the stock market are those true needles. And missing out on those needles negates the purpose of stock market investing in the first place. So that's why I think your best bet literally is simply buying the whole haystack. It's just like John Bogle said, right? Don't look for the needles, just buy the whole haystack. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all at bestinterest.blog. Again, the web address is bestinterest.blog. Check it out. And now I want to invite Andrew Giancola onto the show for a fun debate that he and I had about some controversial opinions in the retirement planning community. Andrew is the host of the Personal Finance Podcast, and I think you'll hear today why his show and his audience is one of the biggest, most popular in the world of personal finance podcasts. So without further ado, here's Andrew Giancola. What the audience might not know is that you and I, 30, 45 minutes ago, were like, hey, what are we going to talk about today? And we kind of brainstormed this fun idea on the fly. So I'm going to work through this list of 10, you could call them controversial takes, 10 retirement and long-term investing topics that, maybe different people have some pretty different opinions on. And we are going to intentionally, we'll say, take different sides. Or at least one of us will argue for something. One of us might play devil's advocate and argue against it. But I think it'll just be a really stimulating and interesting conversation for the audience. We'll start with this one. Number 1, target date funds are good enough for almost everyone. What do you think about target date funds, Andrew?
So target date funds, I think, are fantastic in certain scenarios for certain people. But I think for a lot of folks, they're not always a one-size-fits-all solution. And the reason for this is because they assume that most people are going to have, the same risk tolerance. And so they're looking at this and saying, okay, across the board, if you buy this target date retirement fund at this certain date, then every single person has the same exact risk tolerance. And so this is something where I think personal finance, and especially when it comes to investing in portfolio design, is very personal. And it depends on how you feel about the market, how you react to market conditions, and a lot of other factors that are in play. And if you go with the target date retirement fund, that does not factor in that risk tolerance overall. The second thing is thinking through retirement age. And I think retirement age is a big deal for a lot of folks, where it is probably way too conservative, in my opinion, for a lot of people out there who are aggressive investors or looking to grow their portfolio over time. It gets way too conservative as time goes on. That glide path becomes more and more conservative as they get closer to retirement age. Whereas for me specifically, I would rather be in a larger portion of stocks. That's the way my risk tolerance is. Whereas if I were in a target date retirement fund, I'd have a huge allocation of bonds. And so for me, that would be a big difference there. The third one is it's assuming that everyone has the same income sources. And I think that is a big deal when it comes to folks. Maybe you're invested in real estate. Maybe you have some other assets into play. And so if you have other income sources coming in, it doesn't really help optimize for that. And I think that's a huge deal when it comes to looking at each person's individual situation and then also their tax situation, because the tax situation could be different for each individual. And so that is something where a one-size-fits-all approach can be great for automatic investors. But for me specifically, I think each person needs an individual portfolio and they need to make it work for their specific risk tolerance. In addition, the mix of asset classes that you have in target date retirement funds may not always be optimal depending on where you're getting that target date retirement fund. And so it's very important for a lot of folks out there to kind of look at, a number of different asset classes and what they want to have in place. And so this is just a big deal for most people who have these individual situations, especially as your financial situation gets a little bit more complicated. You really want to have a portfolio designed for exactly what you want.
In my heart of hearts, of course, I agree with everything you just said, right? But for the sake of the conversation, the way I'll push back is I'll say, when I think about the Aunt Ethels out there, the people who just, hey, we're going about our lives. We don't want to know about this investing thing. We just want to make sure we're doing something good enough. I don't care about the complexity. Don't give me 1,000 flavors of ice cream. Just give me 2 flavors of ice cream. Give me chocolate and vanilla and let me make my choice. For those people out there, I think a target date fund is good enough. It's certainly not perfect. It's good enough. I'm glad they exist. Take your typical 401k plan. You've got some mid-20s person earning a paycheck for the first time. They have to make an investment decision, and they look at these things and they say, oh, this fund says if I'm supposed to retire in 2060, this is the fund for me. Well, I'm going to retire in 2060. Let me pick that one. Hey, it might not be that person's portfolio forever. It's probably good enough for the start. I do agree with what you said. Eventually, almost everybody, I would say, needs to get to a point where they, say, graduate beyond a target date fund and find a longer-term portfolio and financial plan that's more specific to their situation.
100%, I agree. And I think the big thing with target date retirement funds for most people out there listening is if you are brand new to investing, if you're like just getting started, it's a great starting point. Like if your 401k offers it, sure, you can start at that point in time and then kind of start to get a financial education or talk to an advisor so you can kind of get this ball rolling in the right direction.
Let's go to number 2 now. International diversification is overrated. I'll go first on this one. Well, I think this is a funny thing because a lot of people have been saying this for the last 15 or so years with the U.S. stocks, the U.S. stock market really not only outperforming but trouncing international markets. That seems to have changed over the last 16 or so months. And my take on this is no, I don't think international diversification is overrated. I think it is properly rated, maybe is the better way, because my take on this and what I will explain to people, if you zoom out over the longest period of time that you can. So you zoom out back to World War II and you look at international markets versus domestic markets, you will see this long-term oscillation back and forth of over and underperformance. Long-term meaning it'll be, in say 5 to 15 year periods where international will be outperforming. Okay, then it pivots back and now US is outperforming back and forth, back and forth. And if you are a long-term investor like you and I are, Andrew, and I think like most of our listeners are, it's very hard to predict when those oscillations will swing back and forth. And I think the safest, smartest, most hands-off, easiest to implement way of investing is to own both. Own domestic, own international, hold them for the long run, and accept the fact that at any given time, you do know that one will be underperforming the other. What's your take?
So I agree with a lot of what you're saying there, but for the argument's sake here, what I want to talk through is when I look at international funds, a lot of times I will look at an international fund and I'll compare the top 10 holdings in an international fund to the top 10 holdings in, say, VTI or VOO, which is the total stock market index fund, or the S&P 500. And when I compare those two, I look at those top 10 holdings and I'm like, man, I would much rather hold the top 10 holdings inside of the S&P 500 than of that international fund, because you can go look at it and like one of the top 10 holdings, for example, in an international fund is typically something like Nestle. And so you look between those two and you can see, oh my goodness, that is a very, very interesting differential there. But the second thing that I would say is that a lot of these index funds out there, VOO and VTI, they have international exposure because they do business across and overseas. And so a lot of the tech companies do business overseas. A lot of these big, large companies are really getting that international exposure there. I think a lot of times I think of J.L. Collins when he says in The Simple Path to Wealth, he only invests in VTI and doesn't add international funds. I think he's added some since, but doesn't add international funds because they have a lot of business happening overseas. And so this is one of those areas where I think that could be something that someone looks into. There's also that currency risk when you look at some of the international exposure where you are depending on other currencies that may not be as strong as the US currency, although we've seen that kind of shift a little bit over the course of the last couple of months. And then there's geopolitical risk, meaning there's a lot of risk out there in terms of what are the international funds kind of invested in, what are they heavily weighted in, and are there going to be wars that happen? Are there going to be other things that are out of your control that you really are going to have to kind of ride that wave during that time frame? But the biggest overall one is obviously over the course of the last 15 to 20 years, international exposure has significantly underperformed U.S. exposure. And so a lot of folks are not investing international as much as they would have because of this. And so the underperformance has been a big deal. It's been something like 4 or 5% in comparison to what the U.S. stocks have done over the last 15 years, around 10%. So I think that's just a big difference as well. And that is where, if you're looking between the two, how I would think about that.
I'm trying to maintain my faith in John Bogle. Reversion to the mean, man. Reversion to the mean. But let's go on to number 3 now. Number 3 on this list, cash is a terrible long-term asset always. What are your thoughts on cash, Andrew?
So cash is something that I am very bullish on for a number of different things. I love cash for security. I love cash for sleeping well at night. I call it coming up with your SWAN number, your sleep well at night number. Ooh. But if you're going to hold cash for the long term, meaning holding a ton of cash on hand, and maybe you have 1 to 2 years of cash in your cash bucket longer term, it is losing value to inflation every single year. And so I like to get my cash working outside of my emergency fund. I like to have that cash working as much as I possibly can. And so if you look at cash and you hold it in that high yield savings account, you could be losing 3, 4, 5% on a yearly basis, depending on whatever that specific inflation rate is. But at the same time, I also think that when you hold cash long term, you're losing out on opportunity cost. And opportunity cost is the biggest overall thing that we want to look at when we get our dollars going. And so you can invest in real estate, you can invest in the stock market, you can invest in businesses, whatever you are trying to do and whatever part of the life cycle you are currently in right now, sitting in cash is not going to help your money grow. And so you need to make sure that you are investing those dollars going forward and making sure that you have these assets that are compounding. In the age of AI, I think ownership and assets are even more important than they have ever been. And so this is something where, for most people, really holding cash is just going to erode away your purchasing power over the course of the next couple of years. We just did a whole thing where we looked at, hey, if you got a 10% rate of return, how much would every single dollar that you invested be worth 20 years from today? And it was $6.73. And so every single dollar that you have in place that you are keeping long-term over the course of that 20 years in cash, you are losing out on that opportunity cost of that dollar turning into $6.73. And so this is something I think that a lot of people need to think through when they are holding cash. It's great for short-term emergencies. It's great to have as an emergency fund. It reduces your stress and anxiety. But once you get past that number, I think it's very important to make sure you're investing your dollars.
Again, challenging to argue with that. And I will say that the premise itself, cash is a terrible long-term asset. Maybe I worded that poorly because everything you just said is correct. And I think to myself, yeah, cash is a terrible long-term asset. And you even alluded to it in your answer, Andrew, where you said, but it's a short-term asset, as an emergency fund asset, as a SWAN, sleep well at night number asset. It's a great asset. And when I think about retirees, when I think about some of our listeners, I think about sequence of returns risk, for example. I think about these things where you say, okay, if something bad happens with my long-term assets, like my stocks or my real estate, my business ownership, whatever that may be, if something bad happens on that side of the ledger, I still need to have enough security on the other side of my ledger to get through the next 6 months, to get through the next 24 months, something like that. And that's where those cash and cash equivalents, maybe like a really short duration bond or something like that's where those things play a vital role. So yes, I think we are in agreement that cash is a terrible long-term asset. But I don't think that anybody out there should write off cash as an asset overall, because I think as a short-term asset, it's perfect. It does exactly a job that we need it to do in our financial plans.
Exactly. I think like what you talk about, like your bucketing method, where you talk about, having those short-term, medium-term, and long-term, methodology. I think that is really, really powerful. And cash is a huge portion of that. And I think you should have, especially for retirees out there, I think they need to have a couple of years of cash on hand in order to protect against sequence of returns risk. And I think that's the biggest thing overall.
Perfect. Let's go to another interesting asset class debatable topic. The fourth one on our list here is you don't need alternatives like real estate, commodities, gold and silver, private equity. Stocks and bonds are enough. What are your thoughts on that? I know you're a real estate guy. I mean, what are your thoughts on all the different options for alternative investments out there and which ones make the most sense to you?
So here's the big one with this argument here is I could see both sides. And this is something that I'm going to actually dive into the opposite of what I've actually done. So I am going to look at this in a way where I invest in real estate personally, I invest in businesses personally, and I invest in the market. Now, this has been something over time that if you want some of these alternative assets and you're looking at buying gold or maybe you're buying crypto and some of these other stuff, I think that it could overcomplicate your financial situation. Where I think stocks and bonds are a great proven asset that over the course of the last 100 years have driven a return that outpaces inflation and has a little bit extra on top of that. And in addition, is something that we have seen hundreds, if not millions of people over the course of just the last decade alone that have been able to retire just on stocks and bonds. And this is something where if you look at some of the studies out there of like Ramsey Solutions did that study where they did like the largest millionaire study, and 80% of those folks became millionaires just in their 401k, just on stocks and bonds. And I think you can have a perfectly fine retirement portfolio with just stocks and bonds, and it is going to be the simple way to do this. I cannot tell you how many headaches I've had just from investing in real estate. There's a lot more work and sweat equity involved in real estate than most people realize if you've never done it. Or how many headaches, and this is 10x real estate, of buying businesses and having to manage people and having to manage employees and all these different things. Now, you can look at commodities, you can look at REITs, you can look at some other ways to invest in business and have these alternative assets. But historically, stocks have outperformed all these other commodities. And a lot of times I'll look at Warren Buffett and I'll say, well, Warren Buffett's putting his family's money in a 90% portfolio of the S&P 500 and 10% in bonds. And so if that is good enough for Warren Buffett and his family, why is it not good enough for me? And I think this is one of those things where it simplifies your life. It makes life so much easier. It is truly a passive way to invest your dollars. It is one of the only passive ways out there to invest your dollars. And a lot of times when it comes to stocks and bonds, they have intrinsic value. And I think this is a very important thing for most people to note, is that stocks and bonds are going to have companies, and backed by companies are going to be balance sheets and P&Ls and different things that they own. And this is going to be a very important metric for a lot of people to think through. Whereas if you look at gold, if you look at crypto, it does not have anything backing it. It is only worth what someone else is willing to pay for it. And so this is why I am okay with just having stocks and bonds in my portfolio. It reduces complication. It reduces, honestly, stress and anxiety. You have to worry less because if you're a long-term investor, you know what direction that market has gone historically, and it has gone in one direction over the long term.
There's a guy I know here in Rochester who is now retired, and to call him a real estate investor might be underselling what he did. I mean, he was a commercial landlord, a residential commercial landlord for 40 years. And by the time he, quote unquote, retired, he owns like 80 units around a nice neighborhood in Rochester and essentially sold his real estate business for tens of millions of dollars. And I think of that guy and it's like, hey, I don't own any investment cash flowing real estate. But to that guy, it was like the only investment option he knew and understood and would ever have put his money in. And even now, when I talk to him about what I'm doing here at work, he's like, yeah, I'm not really big on the stock market. And when I think of that guy, the takeaway I have is you should, to some extent, invest in what you know and invest in what you're comfortable with. And that doesn't necessarily mean that all investments are equal. Like I like you, Andrew, like I don't own, or I shouldn't say this, that intrinsic versus extrinsic argument that you just made about gold and silver, that's an argument that I very much believe in too. And for me, that's enough of an argument for me like, yeah, I don't really want to put my money in gold. But there are other people out there, shout out Alexandra. I know Alexandra's listening to this. She's written to me some fantastic arguments pro gold. And I'm like, you know what? You make a really good point. There's some intellectual arguments about a risk parity in all weather portfolios. There's this longevity argument about like gold is about the oldest investment on planet Earth, if you want to think of it that way. And you're like, okay, I could see how someone can convince themselves with some really intelligent arguments that like, I believe in this investment and I'm going to buy it. I'm going to hold it for a long period of time. And I think over that period of time, this investment is going to do the thing that I need it to do for me. And as long as you're not going to be buying and selling and flipping and doing all these things that we know tend to be bad behaviors for investors of all stripes, as long as you're willing to stay the course, okay, I think that at least your head is in the right place. So when it comes to alternatives, especially maybe more exotic alternatives, that's what I think is if you've truly convinced yourself of the merits of what you're about to do, I get it. But if you're just chasing the hot thing because it's the hot thing, I think we pump the brakes.
I couldn't agree more. And I think that is, honestly, I could see both sides. And really, it comes down to kind of what we talked about earlier, is that it is all down to your personal situation. And I think your situation is going to dictate where you go with that portfolio.
Let's go to number 5. Market timing is simply impossible 100% of the time. I've got some thoughts on market timing here, Andrew. I'll take the first stab at this one. I more or less do agree with this statement. Market timing is simply impossible 100% of the time. I think that investors would be better served if they all assumed that this statement was true. Because in my heart of hearts, I actually think this statement probably isn't true. I think there probably are some times where you can look at the circumstances and say, yeah, something here is wrong. This market is really overvalued. This market is really undervalued. I probably ought to be doing X, Y, and Z right now. But for you to be able to identify those times and act on those times and be consistent with how good you are at identifying and acting on those times, that's where the rubber really meets the road. And that's where the difficulty is. And that's why I say I think people would be better served if they assumed that market timing was impossible. One quick example, and then I'll pass the baton over to you. If an investor were to look at what's called the cyclically adjusted PE ratio, some people call it the Shiller-Cape ratio, CAPE. It basically says, let's look at a company or the stock market's price to earnings. So it's kind of its valuation, how expensive the market is. But let's adjust it over time based on kind of inflation, and let's average it out over a decade, cyclically adjust that PE ratio. If you look at that, and then you look at the future returns of the market. So you go back in history, we say, what was the cyclically adjusted PE ratio in 1980? And then what were the next 10 years of returns from 1980 going forward? And you do that over and over again, month by month over time. You see a pattern. And the pattern basically says, when the market is overvalued, the future returns are lower. And when the market is undervalued, the future returns are higher. And that should make sense. We kind of know this about the market. Of course, if something is overvalued and people are paying too much for it, eventually it's going to revert to the mean. And that basically means some stagnant or negative returns, and vice versa. If it's undervalued, eventually it's going to revert to the mean and you're going to have great returns to bring it back up. I think of that data point as an example and I say, well, an investor out there could make some educated decisions about when they buy or sell based on the cyclically adjusted PE ratio. And there's a legitimate pattern there that might say that market timing could work for them. It's easy to look back in time and see that data. It's hard to be sitting here and we're talking in March of 2026 and say, okay, Andrew, which one of these 1,000 data points are we right now? Are we going to be the one that actually has negative returns? Or are we going to be the one that has mild but still pretty good positive returns? And for an investor to sell right now, they might just end up regretting it. So what are your thoughts on that? I'll pass the baton to you.
To be 100% honest, I 100% agree with you. And I think that's kind of the area. I spent actually an entire year as a full-time day trader. And I know a lot just about market timing and kind of how to think about that over the course of a year. So I have a lot of data points. But I will flip it on the other side and kind of see exactly where we can go with this. Because I think overall, if you look at the way to time markets, well, what is the biggest deal that most people can do? Well, most people can kind of tell you when to get in. Most people can kind of tell you, okay, the market pulled back 20 to 30%. And we're looking at this situation and we're saying to ourselves, well, if the market pulls back 20% and someone had some cash on hand and they invested those dollars, a lot of times they're going to come out in a great situation. And so this is something where market timing could work on macro trends. It could work on things like tightening financial conditions where we see a difference in some of these financial conditions and you see the market pull back. Well, maybe that's an opportunity to buy. And so Warren Buffett always says this, buy low and sell high, but most people never actually do it. And so this is one of those things where I think that if you have a really, really good indication and you have a really well-researched indication of what a company is doing, what their profit and loss statements are, you really dive deep into the company's valuations, you are following every single 10K, you understand what that company is doing, and you have a handful of companies that you're following like this could be something where market timing could work. Let me give you an example of this. Is recently, over the course of the last couple of months, AI is moving really quickly. All of us, nonstop, all we hear about is AI left and right. Well, a lot of these AI companies are in this huge battle, but there are some out there like Meta or Google or these big behemoth of companies that have huge investments that are going into AI. Well, a lot of people don't like how much they are spending on AI. And so for them, some of these companies are getting beat down or pulled back. Amazon is another great example of this, where there's these big, magnificent 7 companies that are spending dollars on AI. Well, a lot of these have had some pullbacks during that time frame, 20 to 30%. But if you know and understand that these companies are not going anywhere anytime soon, and you invest those dollars while they are having these pullbacks, that could be a great situation. Whereas a lot of other folks out there who don't know what they're doing, they try to day trade on stochastic models, or they're looking at candlesticks, they're looking at all these different things, trying to figure out, how to get in and out of some of these investments. And if you go that route where you're looking at it and saying, I'm going to get in right here, and then in a couple hours, I'm going to get out on the same day, I think that's a lot more difficult argument to make, even for me. But for most people out there, I think you can look at something like this with some of these big companies. And if you have an understanding of the background of those companies, you could try to perform this as a mini Warren Buffett or Mohnish Pabrai or whoever else can be the person that you model this after. And I think that is one where there could be some indications of market timing. But again, all in all, I ultimately agree with you.
Listeners, let us know your market timing successes and failures. And now let's pivot to more of maybe a little less about what's going on in the portfolio and a little more about the financial plan and the retirement plan. So here with number 6, we're going to go into retirement planning a little bit. The 4% rule needs a total makeover. What are your thoughts on the 4% rule and safe withdrawal rules, Andrew?
Well, I completely agree that the 4% rule does need a total makeover. I think this is something where it is maybe the safe number for a lot of people to start with and one of the conservative numbers for a lot of people to start with. But I think more so, a lot of folks out there, if you read Bill Bengen's newest book, he has the creator of the 4% rule wrote a book and basically said, hey, the 4% rule is now something that you can spend a little more. And I think his new number is like 4.7% or 4.8%, something somewhere in that range. And for a lot of folks out there, I like the guardrails approach. I like to look at guardrails and I like to say, hey, in some years, we're going to be spending a little more because the market has been up and it's been improving over time. Some years when the market is down and it has these pullbacks, we're going to spend a little less. And when you have flexibility with the amount that you're spending in retirement, I think that is the most powerful place to be because flexibility allows you to make shifts and adjustments over time. And specifically, when you have this approach in place, as long as you have cash on hand, you have some additional things that can help you with sequence of returns risk, I think this can be a very powerful way to look at your portfolio. Now, the 4% rule had a lot of different assumptions. It had a lot of different assumptions about income levels. It had assumptions about, what your portfolio return was going to be. And those assumptions have shifted over the course of the last 15 to 20 years. And so because of this, I think the 4% rule is a conservative approach and someone can start there. But at the same time, I think having more flexibility based on what the market is giving you is the best way to do this. I use a sports analogy when I think about this. You take what the defense is giving you. You take what the market is giving you and you enable yourself to have these guardrails of high and low spending. And that's going to help you optimize your spending so you don't fall short of your spending limits. The last thing I want to do is get to the end of life and know I could have spent a lot more, spent time with my family on vacations or spent time with my family doing specific things. But instead, I decided to hoard this cash because of one specific rule that was just static and I could not move from this rule.
As you pointed out, the retirement research community has made a lot of interesting steps forward, say, over the last decade with things like, the guardrails. Guardrail rules, it's a terrific example of just another option out there that exists for retirees. The 4% rule, the poor 4% rule, I lament the 4% rule. I feel like it's misunderstood in a way. We think about the right tool for the job. And, if I'm out there, let's say I've got this nice 50-foot boat. I'm not a big boat guy, but let's imagine I've got this nice 50-foot boat and I'm trying to pull that boat down to the marina using my little lawn tractor, my little green John Deere lawn tractor, right? And you'd look at it and go, oh my gosh, that tractor is not the right tool for the job. Well, it's not the tractor's fault, right? It's my fault for using the tractor in the wrong way. And I feel like similarly, a lot of the retirement community and maybe a lot of content creators, a lot of the FIRE community, for example, they've taken the 4% rule and they've said, this is the thing we're using to plan our retirement. And if you, just like you alluded to, Andrew, if you go back to Bill Bengen's original research, if you go back to the original Trinity study, if you look at some of the research that Dr. Wade Pfau has done on safe withdrawal rates, what you realize is that the 4% rule is A, it's kind of there to help you with back of the napkin math. And B, it's there to help you with absolute worst case. You set the floor of your retirement using the 4% rule. But then hopefully you build up from the floor in some way into some more flexible strategy or some higher withdrawal rate strategy. And one of the problems that I see is we took this thing that was there to set the floor, and certain people out there have said, no, this is the tool for the job. This is the one and only thing I'm ever going to use for the rest of my life. I do think the 4% rule does need some sort of rebrand, and it's just to remind ourselves of what the tool is versus what the tool isn't. And I think all of our listeners would be better served with some of that knowledge, and it's certainly something we've talked about here before. Here's a quick ad, and then we'll get back to the show. Serious question. Why do podcasters constantly ask for ratings and reviews? Yes, they do help highlight our shows to new listeners. They help strangers find us on Apple Podcasts and Spotify. It's totally true and a good reason to ask for ratings and reviews. But I have something more important, at least more important to me. I want to know if you like this stuff. I want to know if you like my podcast episodes, my monologues, my guests, the information I share with you and the stories I tell. I want to improve and make your listening more enjoyable in the process. So yeah, I would love to read your reviews. And sure, if you throw a rating in there too, that's great. If you like what I'm doing, please share it with me. It's such a great feeling to read your feedback. I'd love to read your review or see a rating on Apple Podcasts or Spotify. Thank you. Let's go on now to number 7. Number 7, again, sticking with retirement planning a little bit, is plan to spend more in your 60s and less later. Intentionally plan your early retirement years to be the years where you spend more because you know you're going to spend less later on. What's your thoughts on decumulation, Andrew?
I think for a lot of folks, there's been a lot of research done on, the retirement spending smile. And I think this is something where I've seen a lot of folks kind of come up in where you spend more in your early years, then kind of the middle portion of your retirement, maybe you get to your 60s. Let's say you retire at 60. And so you get to your 60s, and over the course of the next decade, you decide, okay, I want to travel, I want to have fun, I want to enjoy life during this decade. And so you start to spend a little more during your 60s. And then all of a sudden you're like, I'm over this kind of stuff. I want to spend more time with the grandkids or spend more time with family. And so you spend less in the middle portion of your retirement. And then as you age, well, obviously healthcare costs are going to rise and expenses are going to rise and maybe long-term care is going to rise. And so you start to spend more again. And so I think this is something where there's been a lot of studies showing that the retirement smile is kind of the spending pattern for a lot of retirees. And for most folks out there, that's kind of the approach or the way that I think about it, because it just makes sense. It makes sense for a lot of people. And if you can figure out exactly where you're going to land, this could be a great ordeal. Now, the one thing to factor in is inflation and understanding where inflation is going. If you have really high inflation years during the middle of your retirement smile, then that could make a shift like we had during COVID to now. And so that is something to definitely consider. But I think for a lot of folks, your younger years, the years that you can spend more time traveling and you're agile and you have your health span in place where you can do a lot of different things, is a great time to spend more. Then during the middle, you kind of relax, rest, you use that time for that frame. And then, as time goes on, then you will spend more on healthcare. So that's the way I think about it, at least. But I would love to hear your thoughts.
It's a similar thought process. And it goes back almost to the 4% rule. The 4% rule is this very one-size-fits-all way of planning your retirement spending. But the actual way that people spend retirement is variable. It changes not only year over year, it changes decade over decade. And one of the things that I think most people working in an actual retirement planning field, working with clients, working in wealth management will do, is they'll say, we want to try to project your cash flow on a year-by-year basis. We want to understand all the money that's coming in and going out of your life. And here's a great heuristic that you, Andrew, and the listeners, I think everybody, it's helpful to think of this. The average retired couple goes through 4 major gates that really affect their retirement spending to some extent, their retirement income, maybe their retirement taxes. And those gates are before and after you actually retire. Okay, makes sense. Before you retire, you have income. After you retire, you don't. Before and after you collect Social Security, which maybe as a couple is actually 2 different gates because they're staggering their Social Security claiming in some way. Before and after RMDs start. So that's usually in the early to mid 70s. And then the last one is before and after the first spouse passes away. That's a big change between filing singly and filing joint. And there's some other changes there too. My point there is that retirement can't be thought of as any sort of static spending because, man, there are these big changes that every couple will go through, let alone the travel versus not traveling, the following the grandkids versus not following the grandkids, the long-term care versus not long-term care, all those things that you alluded to, Andrew. So my point is that on an individual basis, it's really important to think through all these different dials on, dials off, flipping it on, flipping it off, trying to project your unique cash flow throughout retirement, and then building a financial plan from there. So yes, should someone plan to spend more in their 60s and less later? Probably most people. I think the answer is yes, they should. And that should be reflected in their kind of unique cash flow projection. All right, let's stick with some decisions that I would say for most retirees occur earlier in retirement. A lot of retirees say, I really need that retirement paycheck. Social Security is there to be my retirement paycheck. So the controversial take here for number 8 is taking Social Security early hurts people more than it helps people. Social Security claiming strategies. Go ahead, Andrew. What do you tell people about when to claim Social Security?
Well, overall, I could see both sides of this argument, and I guess it's more so on your personal, your personal finances more than anything. But for a lot of folks out there, I'm going to take the side on this one of taking it a little bit later. And Jesse actually we had this conversation on our podcast too recently where we were talking through Social Security and kind of thinking about this. But there is nowhere out there where if you take Social Security later, that you could get a guaranteed 8% rate of return, meaning your Social Security is going to be adjusted at 8% every single year the later you take it. And I think this is going to be something where a lot of folks can get that guaranteed rate of return if you don't need the money early. Now, if you need the money early, that's a different situation. But if you don't need the money early, you built up your portfolio in place and you have this portfolio where you can draw down in this portfolio and live off that money early in the year. early in your retirement, that is a very, very powerful place to be. And so you can delay some of these Social Security payments and have the ability to go out and get that guaranteed rate of return. So I think this is the biggest argument overall for a lot of folks. Then you can enjoy that money later on or use it for long-term care or healthcare, whatever other big expenses that you have in life. And so for some folks out there, delaying this is going to give you that guaranteed rate of return.
Yeah, no doubt about what you just said there, Andrew. The other side, and this is something that I will hear, I don't always agree with it, but this is the argument that I hear. So I'll play devil's advocate a little bit. Is someone will say, well, a couple things, Andrew. A is I don't trust it's going to be there if I'm going to delay, so I'm going to claim it early. Okay. It's a fair argument. I'm not sure I agree with it, but it's a fair argument. The other one is I just really sleep better at night knowing I have that guaranteed paycheck. So I'm choosing to retire at 63 and I'm going to turn on Social Security the next day. Okay. I don't know if that's mathematically optimal, but maybe it's some swan. It's helping them sleep at night a little bit. And then the last one this one I genuinely do agree with is, well, first off, I think as a couple, a very tried and true tactic, if you have a married couple who are claiming Social Security, is that the lesser benefit claims earlier and the person with the greater benefit claims later. That's fine. And then the last thing, again, and I think this one has a lot of merit, is if someone's looking at themselves and they say, my mom and dad both passed away in their 50s, I've already had a couple cancer scares, I just have bad genetics, I'm not a particularly healthy person, and for me to delay, they tell me that my break-even age is 80. Well, I don't think I'm going to live to 80, so I'm going to claim it as early as I can and at least get something. I think that's a very fair argument, and I think actually if that person ends up dying earlier, say before 75, before their late 70s, mathematically, they're going to be glad that they claimed early. So I don't necessarily think that taking Social Security early, does it hurt more people than it helps? Well, maybe it does hurt more people than it helps on average. But I do think there are still plenty of very legitimate reasons to claim early. And certainly what we've settled on here is that it deserves a lot of thought and strategy as to when you claim Social Security.
I think it's one of the most strategic things that you need to do when it comes to retirement is to kind of think through this whole scenario, because for a lot of folks out there, and the number one question I get is, hey, should I take it early and invest those dollars? Well, again, you can't get that guaranteed rate of return. What if the market has a dip? What if there's a drop? And so there's things like that where it depends on your personal situation. Now, there's a lot of people out there in this country right now who need Social Security. For most of you listening to this podcast, if you're listening to this podcast, you're likely setting up a financial plan and you are good with money. And so overall, this is something I think that is one of the most important things that you need to talk to someone about when you are planning out that retirement.
I mean, that really is a great point. I think your average listener, my average listener, is in a place where Social Security is less impactful to them. And maybe to some extent, this message that we just shared back and forth, it would be best heard by the people who aren't listening here. Maybe that's a problem on my end for not advertising this podcast well enough. I know we'll do a quick plug here in the middle of the podcast, the Personal Finance Podcast. Andrew, I mean, your listenership is huge. How many people are listening on a regular basis?
We have a little over 500,000 downloads a month. So that's kind of where we stand right now.
That's fantastic. So listeners, go check it out. And now we will continue the show and we will go on to number 9. Number 9 here is that number chasing in retirement. Number chasing is just a distraction from life design. Where do you find the balance between the math versus life in retirement planning?
I think this is a great one. And I think overall, I could see both sides of this argument. Again, a lot of these, I could see both sides and I could probably argue both sides pretty easily. So I will just kind of look for one and take one here. See, here's the thing about the retirement number. I think a lot of people don't set it up and track it properly. I think it's actually a very important number, and it's a number that most people need to think about more often. Whereas if you are younger, and if you are someone out there who's in your 20s, maybe you're in the 30s, your 40s, and you are not close enough to retirement yet to kind of think through what exactly you're going to be spending every single year, I think it is very, very important for those folks to decide, actually, I'm going to track my retirement number on a yearly basis. I think most people just track it too loosely, which is why they don't get the lifestyle design that they want. But if you track your retirement number on a yearly basis, this is going to do a number of different things. Number one is it's going to help you figure out exactly what shifts are happening throughout the entire year. So when I was in my 20s, I was very frugal. I didn't spend a lot of money, and my ultimate goal was to become lean fire. If I was at my lean fire number right now, I'd be miserable. I'd be miserable in life, and I wouldn't want to do exactly what I'm doing now. Why? Because things change. Well, first, I got married, and so my spending decisions have changed dramatically ever since I got married. Then I had my first child, my second child, and my third child. And every single time that I had a big lifestyle change like that, all of a sudden my spending increased. And so I had this increased spending over that time frame, and I'm saying to myself, okay, well, my retirement number has shifted because of this. Now, will all of these expenses be in place when I reach retirement age? Absolutely not. But I think as time goes on, when you just change the dial slowly, it is a very slow change every single year, you'll be able to get to exactly where you want to go. And you're probably going to get there faster than most people would if they weren't tracking this on a yearly basis. And so a lot of times I tell all the people that listen to our show, hey, you need to track this on a yearly basis. We do this at the end of every single year so that you know exactly where you stand. Look at your burn rate and figure out how much you're spending every single year. The easy math is to use the 4% rule math and multiply that by 25 as your baseline. That's the back of the napkin math where you can figure this out. Obviously, there's other factors that come into play that we talk about. But then all of a sudden, you get to your number and you can track it on a yearly basis. And then as time goes on, and as you get closer to that retirement age, especially when you're 5 to 10 years out, that's when it becomes very important to know exactly where you stand with this number. But I think on that yearly basis, it makes sure that A, you're not getting way too far outside of the range that you're supposed to be in, because a lot of people will like track it every 10 years and then all of a sudden they don't know where they stand. Instead, this keeps you on top of it so you can make adjustments on the fly instead of getting way too far behind or way too far ahead. So I think the retirement number is a very important number to track, and you can integrate lifestyle design based on tracking that number.
I swear this is a related question, Andrew. When you have a peanut butter and jelly sandwich, are you more of a peanut butter guy or are you more of a jelly guy?
I'm more of a peanut butter guy.
So am I. See, I'm more of a peanut butter guy, and I'm convinced that when it comes to the numbers of retirement and the life design of retirement, it's a peanut butter and jelly sandwich. If you're all peanut butter, if you're all money, let's say, well, then it's just a peanut butter sandwich. It's fine, but it's not quite the same as peanut butter jelly. And if you're just a life design person, then it's just a jelly sandwich. And again, it's not complete. And you need to find the balance between the two. And it's okay to prefer a little bit of one over the other. I think of these archetypes of clients I work with where I know they are more focused on the numbers, and I know some others are much more focused on the lifestyle. And when someone's really focused on the numbers, I feel like my job is to say, hey, your numbers are actually looking good. You got plenty of peanut butter on that bread. Let's start thinking about the jelly. And then vice versa. When all they want to do is they're thinking about all the amazing trips they're going to take in retirement, they've got that taken care of. But then I'm looking at the numbers and saying, okay, this isn't quite adding up. I need to pull them over to the peanut butter side and say, listen, you got plenty of jelly there. Yeah. Let's think about the peanut butter, crunchy or creamy, Peter Pan or Jif. What's going on here? I think the same thing happens here. So is number chasing a distraction from life design? For some retirees, 100%. But then for other retirees, it's the other way. Life design is a distraction from the fact that they're actually behind on their numbers. So to each their own. I apologize for a little bit of the non-answer. I just hope the peanut butter and jelly metaphor was entertaining along the way.
I loved it. I think that it's spot on. I think that's kind of what it is you need to have both, and you need to have both integrated together as one peanut butter and jelly sandwich, and like you say, and I think that's just the most important thing that most people need to realize is that you need both in order to really have a complete plan.
Listeners, you can send your pictures of sandwiches to Jesse at bestinterest.blog. And that brings us to number 10, a juicy one. I left this one for the end, and it hits a really sweet spot for me. Number 10 is most financial advisors add negative value. I know we've had some conversations offline, Andrew, about this financial advisory industry. What are your thoughts on how most financial advisors interact with people, long-term investors, and retirees?
Well, I'll take the case for this argument so that you can set yourself up here on this.
No, it's okay. Because I'll tell you, I'm going to stay middle of the road. Yeah. I'm going to tell it as I see it, and I'm going to say middle of the road. But go ahead.
I think out there's a number of advisors who are sales related. All they want to do is make sure they make the sale for you and ensure that, they are putting you into products that are going to make them the most money. In fact, I've had folks in my life who I have owned businesses with, got to know them better and got to know them in terms of, like, for example, I've had a business partner in the past who was an advisor, and he was someone who would put people into specific products because the commissions were higher. And I think that was a situation where I realized pretty quickly, you got to make sure you understand who your advisor is before you are going to go out and hire someone. So you need to make sure you're interviewing those advisors and understanding what their philosophies are and understanding how they can help you, because there are advisors out there who are just sales related. There's another one that I interned for. I remember when I was in college, I interned at an advisory, and this specific advisor did the same exact thing. He wanted a certain amount of clients. He wanted to just put them into these specific products. Like, for example, he'd put as many of them as possible into annuities, put as many of them as possible into IULs and those types of things. And so this was one of those areas where he'd make a really, really high commission, and he was just trying to get as many people into those products as possible because of that commission. It may not have been the best thing for them. Instead, he was looking at the commission. Now, he would never say this, but behind closed doors, he was saying this to us. And so this is one of those things where I think a lot of those types of advisors give most other advisors a bad rap because they have this sales mentality and they work at a place where sales is everything. But instead, if you have an advisor like that, you'd be better off having a low-cost index fund than just kind of having that advisor in place. So that's one of those things. But again, I am very middle ground when it comes to this, just like you. In reality, there are just bad apples like there are every other industry.
I'm going to continue my peanut butter and jelly fixation with a funny story. So let's imagine we have people out there who are really hungry. They're in dire straits. They're really hungry. And I decide to open up a shop selling peanut butter jelly sandwiches. And I buy some Wonder Bread, which we know is pretty cheap, store brand peanut butter, store brand jelly, and I start whipping up some sandwiches and I say, hey, $15 each, come get your sandwich. Now, you and I and all the listeners know that's not a $15 sandwich. And if anything, I might be taking advantage of the people who are hungry by selling them. I mean, sure, I'm selling them something they need. They need some sustenance, but I'm not exactly sure this is a fair business model to all involved. And I think there's a parallel there. The way I take it is, the statement was most financial advisors add negative value. I think many do, but I think the way that those many justify themselves is they say, well, listen, this person was starving without me. So even though this product might be suboptimal, maybe I'm not using the best ingredients, I'm certainly charging too much for it, at least they're not starving anymore. I am doing them a service. They're not starving anymore. And sure, maybe there's a way to justify that to themselves. And maybe in some grand cosmic sense, they're able to say it's better than starving out on the street. I think we've graduated beyond that point. I do think that there are many advisors that add negative value. I also know for a fact there are many advisors that add positive value. And I also think a big part of the function, and it's something I try to hit home here on the podcast, is I know a lot of the listeners here are DIYers. I know a lot of the listeners here really enjoy learning this stuff and to some extent just all do it themselves. And if that's you, going back to the peanut butter and jelly metaphor, it's like, listen, you've got a full stomach. You're cooking all your own food. Of course, you're not going to pay someone $15 for a peanut butter and jelly sandwich. You might not even accept a free peanut butter and jelly sandwich because you're cooking gourmet meals at home. But now we say, well, what if there's someone out there where you say, hey, you're really hungry? I'm going to cook you a really nice burger, some fries on the side, really good ingredients, and I'm going to sell it to you for $17. Does that seem fair? I think some people out there will be like, yeah, that seems like a pretty fair deal to me. And that's where that sweet spot is you say, hey, some people out there really need help. They really need to get the stuff right. Is there someone out there who's going to serve them well for a fair cost? Will the fee match the value? All those kind of things. Are they not just sticking them in products for the heck of it, like you said, Andrew, because of the highest commission? I mean, that's BS. That's where our industry needs to get to. And thankfully, there are some advisors out there who do that. So that's my answer there. Maybe I focused on food too much, but I'm hungry. I haven't had breakfast yet.
I love it. I think that was a perfect analogy because that's exactly and that is the biggest argument I heard is like every single time those advisors will say, well, these people have no idea what they're doing, so I'm at least helping them in some way, shape, or form. And that was the big thing. And you nailed that. I think that's exactly what is happening in a lot of situations.
Well, listeners, thank you very much. This episode has been sponsored by Smuckers. You can get Smuckers at your local now. Andrew, thank you so much for coming on. This was super fun. This was 100 times more fun than I thought it would be, and I had a feeling this was going to be pretty fun. If listeners, though, they want to check out more of your takes, more of your topics, you do a really good job of distilling this stuff down into like actionable and understandable next steps. Where can people find they can join maybe the 500,000 people per month listening to the Personal Finance Podcast?
Yes, so you can listen to any podcast player that is out there, wherever you listen. Here, we're on YouTube as well, and any podcast player that's out there, we have the Personal Finance Podcast there. And our entire goal is to make money as simple as possible. So we have big frameworks that we break down into simple, actionable things that you can do. So Jesse, really appreciate you having me on here. And we have 2 episodes with Jesse on there. If you want to check out those interviews, I think those are fantastic. We talked about all different things, retirement, and on both those episodes. And so I think that's a great place to start.
Awesome. Andrew Giancola of the Personal Finance Podcast. Thanks for stopping by. Personal Finance for Long-Term Investors.
Thank you so much for having me.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.